When we calculate settlement costs or closing costs, a closing statement includes each prorated amount either as a debit or a credit. A debit takes money from one of the parties to a transaction. A credit gives money to one of the parties to a transaction. When a prorated amount involves both the seller and the buyer, it appears twice, as a debit to one party and as a credit to the other party. When a prorated amount involves one party and someone other than the other party, the amount will be entered once on the closing statement. Credits to the seller and debits to the buyer in a typical real estate sales transaction include the selling price of the property and prepaid real estate taxes. Those are credits to the seller. The selling price of the property and prepaid real estate taxes. And one more thing to remember when you're calculating closing costs and settlement statements is that the buyer's earnest money is always credited to the buyer. Buyer's earnest money never appears as a debit to the seller. It's credited to the buyer. Now, some expenses and income are prorated between the seller and the buyer. Prorations calculate the number of days owed for the expense or the income. That's what proration means. It means the buyer and seller share the expense or share the income. So the number of days is important. The days may be calculated using either a banker's year or a calendar year. With a banker's year, the year contains 12 months and each month has 30 days, resulting in a banker's year of 360 days. Banker's year is a fictitious thing that we created for purposes of ease of calculations. A calendar year, the year contains 12 months, and each month has the actual number of days in it, 365 days, and there's 366 days in a leap year. Prorations are made either through the day of closing or to the day of closing, depending on state laws. When prorations are made through the day of closing, the seller is responsible for the day of closing. When prorations are made up to the day of closing, the buyer is responsible for the day of closing. State law will determine that, and your questions will tell you whether you use a proration through the day of closing or a proration to the day of closing. The question will be clear. Now, real property taxes are normally assessed from January 1st through December 31st and usually paid in arrears. The seller will owe the buyer for accrued taxes from January 1st through or up to the day of closing. The tax proration will be a debit to the seller because the seller has to pay the taxes for the time the seller owned the property. So we'll debit the seller and credit the buyer. For example, the market value of a home is $115,000. For tax purposes, the home is assessed at 90% of market value. The annual tax rate is $2.50 per $100 of assessed value. The tax year is January 1st through December 31st. No portion of the annual property taxes have been paid at the date of closing. So, if closing is on March 13th, the seller will owe taxes from January 1st through March 13th, because in this case, payments are calculated through the day of closing using a banker's year. So we'll find the exact number of days of accrued taxes from January 1st up to and including the day of closing. Here's what we do. We take 2 months, January and February equals 60 days because we're using 30-day months, banker's year, plus 13 days in March. That's 73 days. And we calculate the annual taxes, market value, times the assessment ratio equals the assessed value, divided by 100 times the tax rate per 100, and we'll get the annual taxes. So, $115,000 times 90%, and we come up with an assessed value of $103,500. The assessed value divided by 100 times the tax rate of $2.50 equals annual taxes of $2,587.50. Now, that's the annual taxes, $2,587.50. Now, we got to find the daily tax. And remember, we're using a banker's year. So we take that annual taxes, which was $2,587.50, divided by 360 equals a daily tax of $7 and a little over 18 cents, probably 19 cents, $7.1875. That's our daily tax. And now we know that the seller owes 73 days worth of taxes. So we'll compute the prorated tax amount by multiplying the daily tax times the days owed. And we'll come up with the dollar amount the seller owes. So $7.1875 times 73 days, which is 30 days in January, 30 days in February, 13 days in March, equals a rounded value of $524.69. That's how much tax the seller owes for January 1st through March 13th. So we do a debit to the seller of $524.69 and a credit to the buyer in the same amount. Whenever you're called upon to calculate interest, always calculate the annual interest first. Always calculate the annual interest first. And then read the question again to determine what you have to do with that annual interest. So, interest on a loan is paid in arrears. That means we use the money first and then we pay the interest on it. That's what paid in arrears means. If the buyer assumes a seller's loan, the interest amount will be prorated. Okay, so when we calculate the dollar amount of a commission, you know what? No one seems to have a problem with this one because everybody wants to know how to calculate their own commission. So usually when I teach this class, this part of the class, no one has a problem with it, but we'll go over it anyway, okay? So the full commission in a sales transaction is a percentage of the sales price, as you know. And that payment or commission is made to the broker as stated in the listing agreement. So to calculate the full commission, we simply take the sales price times the commission rate, and that will give us the full commission amount. For instance, if the sales price is $100,000 and the commission rate is 6%, then the full commission is $6,000. Easy peasy. When we calculate commissions, you know that usually a commission is split between a listing brokerage and a buying brokerage. So sometimes it will be necessary to calculate one broker's share of the commission. Well, for that, you take the full commission times the percentage that brokerage gets, and you'll come up with that brokerage's share of the commission. And when we calculate the salesperson's share of the commission, we take the brokerage share of the full commission times the salesperson's percentage of the brokerage share, and we'll come up with the salesperson's share. For instance, if a property sells for $100,000 and the commission rate is 6%, the full commission is $6,000. If the listing brokerage gets 50% and the buyer's brokerage gets 50%, then each brokerage gets $3,000. And if the salesperson's percent of the brokerage share is 80%, then the salesperson on the listing side gets 80% of $3,000, and the salesperson on the buyer's side gets 80% of $3,000. Let's take another example. A seller lists a home for $200,000 and agreed to pay a full commission of 5%. The home sold 4 weeks later for 90% of the listing price. The listing broker agreed to give the selling broker 50% of the full commission and paid the listing salesperson 50% of her share. The selling broker paid the selling salesperson 60% of his share. How much commission did the selling salesperson receive? Well, let's take a look. We take the sales price of the property, which was $180,000 because it was 90% of the list price. So the sales price was $180,000, 5% commission, which is $9,000. That's the full commission. The listing brokerage would get 50% of that, which would be $4,500, and the selling brokerage would get 50%, which would be $4,500. And on the selling broker's side or the buyer's brokerage side, the selling salesperson gets 60% of $4,500 or $2,700. So the selling salesperson's share is 60% of 50% of the full commission. So when we talk about calculating transfer tax or conveyance tax fees, now not every state has transfer tax fees, but if you live in a state that does, A transfer tax is simply a recording tax or a fee to record the transfer. For example, the state recording tax is 20 cents per $100 or fraction of $100 of the consideration paid or the value of the property, whichever is greater. And the city or county recording tax is 7 cents per $100 or fraction of $100. If a home is sold for $425,000, the total fees are $1,147.50. Here's how we calculate it. We take the total value, $425,000, divided by 100 equals 4,250 units. In other words, there's 4,250 $100s in $425,000. 4,250 units of $100 in $425,000. So we take the total units, 4,250 times 20 cents per unit, and we come up with a recording tax of $850. And to calculate the county recording tax or city recording tax, it's 7 cents per unit. So we take the total units, 4,250 times 7 cents per unit, and we come up with a total city or county recording tax of $297.50. So add those two together, the state recording tax and the city or county recording tax, and we come up with a total recording tax fee or total recording fees of $1,147.50. To calculate the seller's proceeds of a sale or the net to the seller, it's pretty simple. Seller's proceeds are calculated by subtracting any settlement costs and loan payoffs from the gross amount of the purchase price. Pretty simple. You take the full purchase price and then you calculate the seller's settlement costs and the loan payoffs, and that's the seller's net. So when we calculate the funds needed from a buyer at closing, anytime a question asks how much funds are needed from the buyer, the question always means the down payment and the closing cost. So what you need to do is calculate how much down payment is necessary and what is the total of the buyer's closing costs. And the question will always give you enough information to calculate that.